Yeah, sorry for the disturbance. And role of trade facilitators, that is brokers, and mechanism of trading on exchange platform, and what investors should do and shouldn't do. And coming to importance of commodities derivatives market, as all we know that commodities are already traded in the physical markets, right? So what is the necessity of the commodities derivatives market? So in physical markets, if we take any commodity, the price, when it comes to price distortion or when it comes to quality, grade, etc., there are various qualities available. There are various prices for the various qualities and grades that are being traded in the physical markets. And when it comes to minimum support price, which is generally decided by the government, it only applies to some extent, whereas mostly the commodities are traded above or below the MSP prices. So, in order to uh, better the situations, commodity derivatives markets help. First thing, and how it helps, we'll see in the next slides. That is by safeguarding against the price volatility and also discovering the prices in a better way. Commodity derivatives market derives its value. Like generally, what happens in commodities derivatives markets is we have contracts. For example, let's take chana. We have contracts for chana that are being traded in the exchange. So the value of the contract derives from the underlying goods. That is the physical commodity chana. So goods include only tangible goods here, like for example, chana, castor, whatever the commodities that are present. And in commodity derivatives trading, central government has notified that we have to trade only 91 commodities, among which only 40 are being traded. And in order to trade in the commodity derivatives market, you require three accounts to open. One is the trading account, other is the bank account, and the last one is ENWR account. Trading account trading helps you in trading with the exchange, which should be opened only with the SEBI registered broker, and where you have to fill your KYC, that is know your client, and risk disclosure document. And bank account is required in order to deposit the money, that is the margin that is required in order to trade with the broker. And ENWR account is electronic negotiable warehouse receipt account. It's like a demat account which converts your physical commodities into an electronic form and stores. And evolution of commodity exchanges, if you take globally, commodity trading is dated back to 19th century. In 1848, first commodity exchange was established, that is Chicago Board of Trade, and in 1865, futures contract started trading. Before that, used the contracts that are traded are called forwards. And in 1898, Chicago mercantile trade has been started. And before 1980s and 90s, only there used to be manual trading, which is called pit trading. You have probably seen this in recent movies like Harshat Mehta Scam, etc. And in 1980s and 90s, electronic trading had started. And in 2007, both this Chicago Mercantile Trade and Chicago Board of Trade, they both got merged into a single group called CME Group. And even in India, it dates back to 19th century. In 1875, Bombay Cotton Trade Association was established. In 1913, Hapur Chamber of Commerce, which is specially for wheat, was established. And for jute, Calcutta Hessian Exchange in 1919 was established. Like these, many exchanges were established in 19th and 20th centuries. So in 1952, Forward Contracts Regulation Act was enacted, FCRA, and in 1953, a commission, that is a regulatory body in order to regulate these uh, commodity derivatives market. A regulator was established, which is called Forwards Market Commission, just like RBF for banks. So now it is being undertaken by SEBI. FMC, there is no FMC right now. SEBI looks after all the exchanges, whether it is commodity exchanges or whether it is stock exchanges. Everything comes under SEBI right now. From 2015, it started. So when it comes to global commodity exchanges, we have in USA we have four main commodity exchanges. That is CME. That is we have already seen that CBOT and CME both got merged. And Kansas Board of Trade, City Board of Trade, New York Board of Trade, and New York Mercantile Exchange. And in London we have London Metal Exchange, and in China Dalian Commodity Exchange. And when it comes to India, we have three main commodity derivatives exchanges here. First is NCDEX, that is National Commodities and Derivatives Exchange Limited, which mainly deals with the agri commodities, and MCX, which deals mainly in the non-agri space, that is metals, bullion, etc., and energy, etc. ICX is also, that is Indian Commodity Exchange, which deals with uh, agri space or as well as the non-agri, but it's mainly famous for diamond. Names of stock exchanges, this most of you might have known, that is BSE and NSE, Bombay Stock Exchange and National Stock Exchange. These deal with equity markets. And commodities that are being traded on the stock exchanges, that is commodity exchanges in India, are the following, like barley, castor, you have cereals, oilseeds, pulses, everything. And when it comes composition of commodity derivatives ecosystem, like we have different players in the commodity derivative segment. They are hedgers, arbitragers, speculators, brokers. So when it comes to hedgers, these are the people who actually get exposed to the physical commodity. For example, if you take a farmer actually produces the good. So what risk he have? During harvesting, the prices may go down. So these players who actually exposed to physical market, sorry, actually exposed to physical commodity are called hedgers. For example, processors. What processor have the risk is the prices may go up so that his raw material cost increases. So these kind of players can hedge. So what these players do is actually hedging in the exchange. We'll discuss in the coming slides how it happens. And coming to speculators, speculators are like traders who you see, like who doesn't have anything to deal with the commodity, but they only take advantage of the price movements that happen in the commodities. Like for example, if he believes that the prices are going to increase, he buys the commodity and he sells when the prices rise. He have nothing to deal with the commodity, like a processor who processes the commodity. And coming to arbitrages, to tell in an example, for example, if you take onion prices, generally, if you take in Ahmedabad, the onion prices are 80 rupees per kg. And in Rajkot, if the prices are 50 rupees, what arbitragers do is they buy from the area where the prices are less and they sell in an area where in the markets where the prices are high. So they buy in Rajkot and they sell in Ahmedabad. So they bring equilibrium between the different markets. It could be physical market and exchanges, or in between exchanges, or in between physical markets also. Brokers are trading members. Broker can be broker. Broker is generally a member of the exchange who trades on his behalf as well as his client behalf. Composition of commodity derivative ecosystem. These are the like stock exchanges. These provide stock exchanges generally provide the platform to trade. What clearing corporations do is they clear and settles the uh, contracts. How they do it, we'll discuss. And repositories, as I have told you already, ENWR. It's just like uh, CDSL or NDSL. If you know about the equity markets, who deal with the electronic store. Here repository is NERL, which deals with the electronic storage of the physical commodity. And there are various other stakeholders like warehouse service providers, that is warehouses which stores the physical goods. and WDRA, that is Warehouse Development Regulatory Authority, which regulates the WSPs, and quality assayers, where the testing of the uh, quality of the goods that is commodities that are to be delivered is generally done by the quality assayers or testing labs. And price polling agencies, they deal with the physical markets and poll the spot prices, because futures and physical markets generally go in tandem with each other. So uh, polling spot prices is also very important for a agriculture exchange. And FPOs, as you already know, who deal on behalf of the farmers as an organization. And when it comes to difference between the commodity and the equity derivatives market, here in the commodity derivatives market, the underlying is being standardized as per the exchange specification and has expiry date. Like we deal with the agri commodities or any commodity which are generally perishable or semi-perishable in nature. So the commodities here have expiry dates, whereas in equity market they are perpetual. They have no expiry dates, and there also the underlyings are being standardized in order to facilitate trade generally. And the underlying market in the commodity markets are fragmented, as all of you know, and the price disparities is present in the physical markets. Whereas in equity market, with if you take a share of any company, it's same, mostly same, or a slight difference will be present between whether it is BSE or NSE. And underlying supply, the supply of estimation of agri commodities is very difficult. It's very uncertain because it's dependent on various other factors. It's dependent on the weather also. So the supply is very uncertain here, whereas the supply in the equity derivatives market is certain. Everybody knows it in the public domain. And when it comes to participants, here the traders, brokers, and FPOs who deal in the physical markets or physical commodities generally participate here. And when it comes to equity derivatives market, they are classified as retail participants, HNIs, or institutional participants. Like for example, LIC is an institutional participant, whereas a retail participant is you or me. And settlement, here the physical settlement takes place with the physical goods. Like most of the commodities that are traded on the exchange are compulsory deliverable commodities. That is, they have to be settled definitely with the physical goods at the expiry of the contract. Whereas in the equity derivatives market, it doesn't happen. The demat settlement happens. That is, the shares get transferred from one demat account to other. In commodity derivatives market, price sensitivity is really high, whereas in equity markets, it's not that high compared to commodity derivatives market. And sophisticated level of participation is low because in equity, the markets are more mature than the commodities market. So the participation is more there. As we have discussed already, benefits of commodity derivatives trading, uh, price disc the main two benefits are price discovery and price risk mitigation. Price discovery is, as the number of participants are more in the uh, commodity derivatives trading, efficient price discovery happens, whereas in compared to the physical markets where the limited participants are present. And price risk mitigation, here in the commodity derivatives trading, we have different kinds of derivatives like options, futures, which helps in price risk mitigation. Like for example, futures, uh, if a farmer believes that, generally a farmer have a fear that the prices may decrease in the at the time of harvesting. So if you take an example, chena is a rabi crop, and generally the arrivals start from March. So we have a contract which trades in the March. Uh, we have a March contract that expires in March. That means that the delivery should be given in the end of March. So, but they are traded right now. So a farmer can lock the prices. That is, he can become a seller over here, and he can lock the prices so that he can give delivery in the March at a at the prices that are decided right now, which reduces his price risk. Elimination of counterparty risk. Exchanges generally deal with the members, so counterparty risks eliminate here, as members are responsible for the settlement to happen, and access to all type of market participants. Obviously, anybody who can open these accounts that I have told you can obviously participate in the market. And standardized products, this gives confidence to the buyer that if you go to a physical market, you don't know, if you want to buy jeera, you don't know which quality of jeera that you are going to get. But when it comes to exchanges, the products are already standardized, that is, the parameters are already set. So a buyer and a seller can be can deal easily that I have to deliver this quality parameters to the exchange, and a buyer can be on the safe side that I will definitely get these quality parametered commodity from the exchange if I take a delivery from there. And it's transparent trading platform as it is open to all. And definition of key terms, if you take final settlement price, this is the price at which the settlement happens at the end, at the expiry date. Generally we have contracts which expires on the 20th of the expiry month. So the last 3 trading days, that is 18, 19 and 20, if the 3 are the working days, we take the average of those 3 days spot price, and that is decided as the final settlement price. And what is M to M? Mark to market margin. Suppose if a trade happened at a rupees of 1000 and I am a buyer, and the closing price of the trade happens to be and I bought at 1000 rupees, and the closing price happens to be 1100, I have got a profit of 100 rupees, which will be credited into my account next day. This is called mark to market. From the seller's account, that will be credited to the buyer's account as the prices have gone up. If the prices go down, opposite happens. From the buyer's account, it will go into the seller's account. And offset is generally a square off. Like I have a buy position in the previous example. So if I want to book profit, what I would do, I sell the position and I get exit with a profit of 100 rupees. This is called offset, liquidation of the futures contract by entering opposite position. I had a buy position, I have entered into sell position. And next comes the staggered delivery. It's a very important thing. Uh, Staggered delivery period is the last 5 working days of the uh, contract. Like for example, if 20th is the expiry and 20th is the expiry, staggered delivery starts from 16th if all the days are working. So from 16th to 20th is generally staggered delivery period, during which buyers and sellers can give their intention whether to take delivery or not. In order to take delivery at so that if the intention gets matched, and the delivery happens even before the expiry date. Commodity index, these are if you take example of Sensex, what it is generally a component which tells you how the markets are moving in the equity market. In the same way, in a commodity market, index tells you how the overall market is moving. It gives you a trend to which, like, it gives you a trend which the market is already following. And when it comes to delivery logic, how the delivery should happen depends on the delivery logic. Most of the contracts that are being traded on the exchange are compulsory delivery. Uh, if unless it is specified, most of them are compulsory delivery contracts. in a compulsory delivery contracts, if you have an open position until the end, that is until the expiry of the contract, what what happens is they delve into physical compulsory delivery. That is, a buyer and seller who are uh, open till the expiry of the contract, they have buyer have to take the delivery and seller have to give the delivery. If that doesn't happen, penalties will be applied on whomever it is, whoever it is, that is the party that is going to be defaulted. Sorry, who is defaulting. And in seller's option, seller gives his intention that I will give the delivery. So buyer has no other option. He just have to accept the delivery if seller wanted to give delivery. But we generally don't have this in our market, in our exchange. When it comes to intention matching, both buyer and seller gives their intention in order to give the delivery. Their intention should match both in the quantity as well as the delivery center, that is location. If both matches, then uh, they get into physical delivery, or else they will be cash settled. And how the price discovery helps, like I've already told you, for example, chana, which is a rabi crop, which generally arrives in the month of March, but that is being traded from now itself on the exchange. So what price it could be like the prices are derived from now itself, that what could be the price of chana in the month of March. So what farmers can do, they can log the prices, or sorry, in the price discovery they can see the prices, and they can uh, decide whether which crop to grow. And this also helps in their improving their bargaining power, and also facilitates the dependence on the commission agents or middlemen. And the price risk management, as I've already told, he can lock his price, so he need not other uh, worry about the price volatility. He can concentrate on the other things, like it may be production or quality or other things. So this is just an example. Since I've locked my price, uh, I could I covered the losses. Key features of contract specifications. Here we have trade parameters as well as risk parameters. When it comes to trade parameters, basis center, as we have discussed, for every commodity there are various grades, various qualities. So which quality or which grade have to be are traded on the exchange. In order to decide that, we choose a basis center, that is an APMC or a mandi, which is a major production center or a major trading center. Major production or a major trading center, which is decided as a basis center. So depending on the basis center, we decide which basis variety that is to be traded on the exchange. And when it comes to trading unit or delivery unit, for example, if you take castor, 5 metric ton is the trading unit. So the trading happens only in 5 metric ton or in the multiples of 5 metric ton. Same with the delivery unit. Delivery happens only in the multiples of them. So when it comes to tick size, uh, a trader tick size is the minimum. Like for example, if the trade is happening at 1,000 rupees and the tick size is 2 rupees, they have to move their next price to 1,002 or 998. It can't be traded at 1,001 or 999. That is tick size, the minimum amount that should be moved. And additional delivery centers, apart from basis center, we also have additional delivery centers for different depending on the commodities where they are grown or where they are traded. And timing of the trading is generally all the commodities trade from 9 to 5, whereas international commodities like soya, refined oil, etc., trade till from 9 to 9 a.m. to 9 p.m. And quality parameters, as I've already told, everything is standardized in the exchange. So quality parameters also. So for example, a commodity should, if an exchange, if we decide that quality, that the maximum moisture that is accepted is 4%, the commodity that is being delivered to the exchange shouldn't have the moisture more than 5%, which will sorry, more than 4%, which is rejected. So these quality parameters have been set. And delivery specification, as we have seen, whether it is staggered delivery, sorry, compulsory, staggered with compulsory delivery, or else cash settled, we have seen it in the delivery logic. And maturity date or due date, that is the expiry date. And risk parameters, uh, sorry, every member and every client have a limit on their open positions. They can't only a single member, because they can move the market accordingly, like however they want to. So that doesn't happen over here, because there are limits on the open positions that are present. And daily limit on the price fluctuations is, we have a daily price limit of 3 plus 1, that is the prices can only move uh, maximum to 4%. Above that, it's not possible to move. Like uh, after the prices move above or below three prices, there is a cooling period for 15 minutes, and after which 1% is raised. Like the limit is raised to 4%. And there are different margins, that is initial margin, extra loss, extreme loss margin, special margin. These occur on different cases, like depending on the price movement, the different margins apply. And final settlement price, we have already discussed. Types of commodity derivative products, we have generally futures contract and options contract. What is a futures contract? If a farmer want to let's take same example, that is chana. If a farmer wants to sell his produce at a specific price in March, so he will make a contract now itself, that I can be able to sell it at a specified price in the month of March. So if the prices move down, even then he'll be able to sell it at a specified price, as he have locked his prices. But the problem in this is, if the prices are going to rise, if the prices rise after he have locked his prices, he's going to lose, because he can actually sell in the physical market. But option contracts provides him that right. Like if he buy a put contract, a buyer of a put contract uh, have an option either to deliver the product or not. If he finds the physical market is having higher price than the uh, price that actually is being traded between them, he can sell it in the physical market. Or else, if the prices get down, he can deliver it at in the in the on the exchange, but he have to pay a premium for that in order to trade on the options contract. Role of commodity exchange, we have already discussed this. So price fair price discovery performs the role of bringing trader and seller together. So it acts as a intermediary between them. Information to farmers, like we have seen in the as seen before in the before slide. And neutrality, that is because you don't know who is selling you or who is buying from you, so there is no conflict of interest being present between them. And transparent real time price dissemination, this can be used as a benchmark price. And liquidity to participants, risk management in a volatile market. As we have seen, there are various risk parameters that are being set up by the exchange. So better risk management happens on the exchange. Robust and robust clearing and settlement systems are being present, and fair, safe, orderly market with rigorous financial standards and surveillance procedures. And benefits of trade on futures market. It helps in the risk transfer from the hedgers to speculators, and also it gives the long-term price signals to farmers. And for for a speculator, it's a or a for an arbitrager, it's a good invest. It creates a good investment opportunity. Like for example, if the in the physical market the prices are low, and in the futures market if the prices are high, he can an arbitrager can buy from the physical market and deliver it on the exchange. And when it comes to warehousing, we have WSPs, that is warehouse service provider, who will ensure of stocking of goods, maintaining their value, and also helps in facilitating the delivery. A warehouse the WSPs that are present on the exchange are registered with WDRA, and WSP empanelment committee with clearing corporation. How the depositing of goods happen in the warehouse? First, a seller have to aggregate the goods as per the contract specifications that are specified by the exchange, and he have to book the space online and arrange the transport. He have to deposit in the exchange. Then quality testing happens, and if it passes through the quality testing, then the ENWR receipt generates, and after generating it, it comes to your ENWR account, and then it can be traded. It can be given delivery on the exchange. Clearing and settlement. Every exchange has clearing corporation which does this uh, process called clearing and settlement. Clearing is nothing but a bookkeeping. Like you and I have executed a trade, so the the bookkeeping is called clearing. And when it comes to actual settlement, that is whether it is M2M, that is mark to market, or else the final settlement, that that is uh, taking of goods, and if it is a seller, taking out goods from him and giving money to him, that is this actual settlement. So clearing is bookkeeping and settlement is the actual settlement of the uh, contract. The entities that are involved are clearing corporation and clearing members are the brokers that through whom you trade, and clearing banks through generally where you have bank accounts, and the repositories which maintains your commodity in an electronic format. And in 2015, SEBI has taken control over the commodity derivatives market, and these are the recent initiatives that are uh, being done by SEBI. It permitted options contract with commodity futures as an underlying, that is called options, and it also implemented risk management norms as for the it is same as like equity derivatives market, and revised warehousing norms for agriculture commodity derivative segment. It also integrated commodity and equity broking activities, and it also permitted options in goods, that is options which will delve into physical deliveries rather than delving into the futures contract. And staggered delivery period actually was 10 days before SEBI, and it has been reduced to 5 days. Permitted mutual funds and alternate investment funds, EFEs, portfolio managers to trade in commodity derivatives market. Alignment of trading lot and delivery lot before if it is the trading lot is 5 MT, delivery lot cannot be 10 MT. They both should be same. And these are the do's and do nots that an investor should follow. Every every investor should only trade through SEBI registered member, and you have to insist on risk disclosure documents. You have to follow the KYC norms, and also code for unique client code. Every client who trades have unique client code, and insist broker to provide the contract note after every settlement. After every settlement, clearing corporations provide contract notes, and which should be which a broker should definitely give it to the client, and cross check the trades that you have done with the uh, trades that are shown, and register your mobile number and email ID with the stockbroker. Issue the demand draft or payee check in the name of broker. Insist the periodical statement or accounts from the broker and verify it. Pay required margin and mark to market obligation in time to avoid penalties. Keep away from the dabba trading because it's very risky and they don't have any risk management facilities. And before trading, get details of the brokerage that is being charged and other fees that are being charged by the member. And don't get carried away with the luring advertisements or rumors. Don't accept unsigned or duplicate contract notes. Do not let risks against positions accumulate beyond your capacity. Do not miss on keeping your track of your financial positions, and don't neglect the writing orders for higher value given over phone. Don't share your internet trading account password with anyone. Do not pay brokerage in excess to the rates prescribed by the exchange. Do not enter into assured returns agreements. Nobody can give you any assured returns. So if anybody tells it, don't get assured. Don't rely on them. So do not forget to take note of risk involved in trading. Do not delay payment or deliveries of commodities to members in order to avoid the penalties. And do not issue checks in the name of authorized persons. Issue only in the name of broker. If you have any questions, please let us know. I hope there are no questions. Thank you.